Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It's lecture time, and this week we're going to talk about how you can make more money with one small change in your trading, all right? You guys are overcomplicating the process, making this business way more difficult than it needs to be, but today we're going to make one small change to accelerate profits, all right? Trust me, it's a good one, and it's a topic. It's probably been 3 or 4 years since I've even talked about this topic. So you definitely want to stick around for it, guys, because I think it's something that will absolutely help you become a better trader. If you like the videos, please click that like button, hammer that subscribe button. I'm Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is how to maximize your trading profits with one small change. And I guarantee you, this is a topic that you're not expecting. And one that I haven't done in years, plural. It's been a long time. Hopefully it speaks to some of you. It takes a little bit of brass in the pocket to do this, but it is a very effective way to maximize profits, make money, and be a generally better trader. Now, obviously, you're certainly going to want to take good trades, but I just think a lot of traders are their own worst enemy, if that makes sense. A lot of times you're doing many things correctly, but you're letting one thing ruin everything else, right? Does that sound like you a lot of times, where it's like you check off a list of 10 things and you're like, yeah, I got 8 or 9 of these things down. But that one thing you're struggling with tends to supersede or overcome all the other good things that you're doing. And it's not good, right? For example, being up Monday, Tuesday, Wednesday, Thursday, and having one bad Friday, taking out all your gains from Monday to Thursday. And that one thing on Friday might have been adding to a losing trade, or not taking a stop loss, or over trading, or something like that. So it's just something you have. Trading's a business where it's forgiving and very unforgiving. Meaning it's forgiving because tomorrow you're going to get another opportunity to trade. That's the forgiving part of trading. The unforgiving part of trading is you can't make many mistakes. And if you do, the market's going to take your money, and you're going to pay for those mistakes, okay? So my point simply is, to be a great trader, you have to know your game and not deviate from your game, all right? We're all good at something and not good at other things. Focus on your strengths, try to minimize your weaknesses, and try to keep out the mistakes. And a lot of that's psychology, although today's lecture is not about psychology. A lot of it's psychological. So let's talk about this concept. All right, right here we have a chart with a 5-minute and a 2-minute chart, okay, with 2 separate trades on it. Right over here, the entry is $204. It's kind of a pseudo. The first bar is a little bit lower than the other two. It's like a pseudo 4-bar play, right? 204 is the entry. Stop loss is 203.35. Okay, so standard trade is, in this case, just for the lecture purposes, standard trade is to get 2 to 1, reward to risk, right? So in this case, a $1.30 gain, or 205.30, right? If your stop loss is 65 cents, 65 cents times 2 is $1.30, right? And that would make 204 plus $1.30 is 205.30. Okay, so the entry is 204, the stop loss 203.35. Say you're hypothetical, you're risking $500. You need about roughly 770 shares. Okay. Target, 205.30, gain $1,000. That's perfect, right? It pops up, it pulls back, and boom, it goes up to like 206.50. So in this case, this is a winning trade. Cool, great. Same exact chart, right? Same exact chart, but now you have a 2-minute buy setup, right? Lower high, lower high, lower high, lower high, bottoming tail, doji bell, a little bit of support right there. You get in at 203.85. Stop loss is 203.50. Okay, a little tighter, 35 cents instead of 65 cents. So same, entry 203.85, stop loss 203.50, risk 500. You need, I think it's right, 1,428 shares. Let me just do that real quick. Yep, that's right. Okay, roughly 1,428 shares. And your target 2 to 1 is 204.55. It's tighter, smaller, because you're in earlier and the stop is tighter. And then you get that basically right there, prior pivot high, something like that. Okay, two separate trades, completely standalone trades. This first one is kind of a pseudo 4-bar play. The second one is a buy setup, right? You guys know where I'm going with this now. You're like, oh, I think I know where he's going with this. What if you didn't treat it as two separate trades? What if you treated it as two separate trades that are the same? You're like, what? You just said the same thing. What if Jordan's on point? You're always on point. You've been quiet, though, lately. What's going on with you? In the chat room, I mean. I'm waiting for your brilliant ideas. What if you added? So let me explain. Let me go back. You can't really take both of these trades, right? True or false? If you take the first trade, you're still in the first trade when the second trade triggers, right? You are still in the first trade. It goes up to like 204.60, pulls back, and then hits target. So you're still in this trade when the second trade triggers. So most of you would skip the second trade. Tell me I'm wrong. You don't have to tell me. It's rhetorical. I watch you guys every day. All right? Most of you would take the first trade and just skip the second trade. You'd be like, all right, I'm already in it. Yes, that's what most of you would do. Okay? But what if you grew a pair, all right, and you put some big old brass in your pocket, okay? And you said, well, I'm already in it with 770 shares. I'm already in it. And I'm watching this thing pull back. And I go, this thing's starting to look pretty good, right? It's starting to look pretty good. And then you start seeing the buy setup form, and then the bottoming tail, and then the doji bar, and you're like, I can't take that. But you can. You can. And the reason you can is you're gaining 15 cents on the stop loss, right? It's not 203.35 anymore. It's 203.50. So you're gaining 15 cents and your entry's 15 cents lower. So if you choose to add shares, your cost average will come down and your stop loss goes up. Think about what I just said. Your cost average comes down and your stop loss goes up. That's shrinking the trade, which means you can add more shares. Okay? Oh, Val. You can, right? So second entry, 203.85. Stop loss, 203.50. The risk is going to have to be $115 or 330 shares. Why? Because when we do add and reduce, you can never, ever, ever risk more than your maximum risk. Your maximum risk is $500. You cannot go higher than $500. Okay? So if you bought 330 shares at 203.85, okay, your cost average is now 203.95, give or take. Your stop loss has been raised to 203.50. So now you have a 45-cent stop loss. So the original trade had a 65-cent stop loss. The second trade had a 35-cent stop loss, and we're kind of not quite cutting the difference, but close. So now all in, you have 1,100 shares. If you hit the original target, which was 205.30, that was the original target, okay, you're gaining yourself almost 1R, right? 1R is $500. You're gaining 479, which is about 1R. So you could have taken the first trade and gone to that 205 target and made $1,000. You could have added with no more risk. I want to be very clear about that. You could have added with no more risk. There is no additional risk. It's still $500. You're not risking any more money. and ride it to 205.30 and you made yourself an extra 1R. That sounds like a good idea, right? Now, if you missed the first trade, you could have just taken the second trade and done really well. But we're assuming you took the first trade. Okay? So let me break it down like this for you guys. Okay? A lot of people get very confused with this. I don't know why, they just do. You can't go above $500. That's your max. That's the one thing you always have to keep. You can't go above $500, all right? But if you add and raise your stop and lower the average cost, you gain. Your risk becomes smaller, right? Appease me for a second, just for a moment. If you had the first entry at 204 and the stop is 203.35, you have a $500 risk. Duh, right? But what if you raise the stop to 203.50? Now it's a 50-cent stop loss, right? With 770 shares, right? And now your risk is $385. Do you guys understand right now, like, where I'm going with that? Some people are like, well, how do I know how much I can add or how much I can't add? Well, the first thing you're going to do is raise your stop loss up to the new stop loss, right? So the original stop loss is 203.35, but the new stop loss is 203.50. So the first thing you're going to do is go, okay, what if I don't add and just raise my stop to 203.50? Well, your risk gets cut down $115. Your risk goes to $385. Why? Because you raised your stop loss 15 cents. So now you have $115 to play with if you want to. You don't have to. You can just raise your stop loss and ride it out. That's fine. But now you know, you're like, well, I got $115 just laying on the table. I'm not utilizing it. I'm not doing anything with it. What if I put that $115 to work? Instead of sitting on the sofa eating potato chips, why don't I put that $115 to work? Well, that's what we did. And that $115 was 330 shares, right? On this trade, right? And what did it ultimately do? It also lowered your entry price, not by much, only 4 or 5 cents. So now you have 1,100 shares, roughly a $500 risk, and that's your gain, potentially $1.34. And you can see $14.79 versus 1,000. Okay? By adding a 203.85, you gain an extra 1R 500. Okay, now let's do it again. Now, what do we have? This is a great opportunity to take advantage of a trending stock. This stock is already in an uptrend. It rips higher, pulls back, gives you an area of support, 50% retracement, rising moving average, bottoming tail, narrow body bar. It's got a lot of goodness to it, right? There's a lot of good things going on here in this chart. So you're looking at this and you're thinking, okay, I see an opportunity here, right? Cool. We're going to get granular with this. It's going to get a little bit complicated in a couple minutes. But right now, let's keep it simple, and we'll just get slightly more complicated as we go each slide, okay? So you're all looking at it going, sweet, I like it. That's a nice buy setup. You know, you're getting in at like, I don't know, 43.10 or something like that, and your stop's very tight, very, very tight. Okay, cool, right? Cool. Now, let's take a little more of the future off. Same chart. We just took a little bit of the gray off. So there's the buy setup. Cool. Now you're like, whoa, wait a second. What's this? Right, what's this? This is a nice consolidation holding the rising moving average. And this consolidation is between this high and this pivot low, and you're like, that's not bad also. Again, look at it riding the moving average here. Beautiful, right? Beautiful. That's a possible area to add. Or it's a standalone trade. See, the best ads are standalone trades, meaning you're not adding just because you're already in it. You're adding because it's a trade by itself. The first one, this is a trade by itself. The second one, that's a trade by itself. But if we add, we can just have one big trade, okay? But no additional risk. No additional risk. Okay, now let's do it again. This just keeps getting better and better and better, doesn't it? Now I have buy setup down here, breakout over here, 3-bar play up here. And yet, most traders will just take the first trade, walk away. They'll just take the first trade and walk away. They won't even get back in on the breakout. Oh, I can't take the same stock twice. You don't have to answer, rhetorical. How many of you guys have like an emotional block about taking the same stock symbol twice in the same day? Not if you stopped out, because I know you're jonesing to take it if you stop out. If you stop out, you're like, I'm getting back in this thing. But if you hit your target, tell me the truth. Don't. It's rhetorical. How many of you are scared shitless to take the second trade? You win on the first trade, and you're like, oh, I already got my money from that stock today. I'm not going to be overly greedy, so I'm not going to take the breakout. I'm not going to take the 3-bar play. I would say most of you. Now, if you stop out on that first trade, you're like, yeah, I'm getting right back in. Heck yeah, look at this. I'm getting right back in. It's a mental mind F, right? That's the truth. It's a mind F, okay? So when you look at it, buy, setup, breakout, 3-bar play is what? 3 cents below the low of the day? Wait the 3 cents, PS, if you're that concerned. Wait the 3 cents, right? Man, so you're looking at it and you're like, juicy, right? So let's keep going. Now we take the whole thing off and you're like, holy shit, right? Buy, setup, breakout, 3-bar play, rip. Holds that trend line pretty well, right? Holds that trend line pretty well. So now the average trader just takes the first trade right there and they just walk away, right? They just take the first trade and walk away. And that's okay. There's nothing wrong with that. I'm not trying to tell you that taking a good trade is bad. Taking a good trade is good. I'm just simply saying, could we grow a pair, take what is a genuinely nice breakout and 3-bar play, and accelerate our profits? The answer is yes, if you have some stones, right? So there's the 3 entries. For those of you that are struggling to see them, entry here. Ali, is my arrow in the right spot? I'm just messing with you. Entry here. Entry here. Oh, what is this? Little topping tail? Monster volume spike after 1, 2, 3, 4 bars up. And 3 of those 4 bars are really wide range bars. I would say that's what? Novice ending volume, right? Novice ending volume, right? Okay. So that's what it looks like. Now let's apply some numbers to it. Now let's make that blue. Why is that not blue? That's, no, outline. That's better. Sorry, guys. All the other slides are blue. All right, so now let's get to it, okay? Let's get to it. Now, I'm going to fry some of your brains here. So take your calculator out and get a piece of paper at the same time. This is the part that really just messes with people. They just have a hard time with this, okay? Which is why, and I can't say that. That would not be politically correct. Never mind. Let's move on, all right? Let's just say it's why people like me never win math competitions, okay? People that look like me. People that look like my kids do, just not people that look like me. So, let's fry the brain, okay? First entry is 43.15, okay? First stop loss is 43.05, okay? That's the very first trade. So, 5-minute buy setup entry is 43.15, stops 40. So, if we're doing $500 risk, don't worry, I'm going to break it all down on the next slide, okay? So, if we're doing $500 risk, 10-cent stop, we need 5,000 shares. That's a lot. Okay? That's a lot. Moves up. Right? Moves up. Consolidates out. Okay? 43.40. Second entry. Stop. 43.30. That's the breakout entry right there. That's the breakout entry. Okay? Third entry is 43.55. 3-bar play. Stop is 43.45. That's the 3-bar play right there. If you had bought 5,000 shares at 43.15, with a 10-cent stop and sold at 44.10, okay, which is way up here, you would have made $4,750 or 9.5 R, which is extremely impressive, right? Extremely impressive. 9.5 R on any trade is amazing. Amazing. But how much could you have made by adding? Well, the average entry would have been 43.36. The new raised stop would have been 43.45. You're already in the money with 15,000 shares. You would have made $11,000. $11,000. And you never, ever, 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 ever incurred more than 1 R risk. In fact, you're about to see it on the next slide. In fact, after the first trade, right at the first ad, second trade, first ad, right? You're already in the money. You're already in the money. And you're like, what does that mean? Let me show you. Okay, so you took the first trade. There's risk on the first trade. You could have stopped out. But by the time you add on the second trade at 43.40, you can't lose anymore. It's impossible. Let me show you how. Let me show you. Assume a $500 risk per trade and a full lot add for each new trade. So here's the initial entry. 43.15 by 43.05. You bought 5,000 shares. So far, you're with me. You're with me, okay? Second entry was a 5-minute breakout. 43.40 by 43.30, okay? Let me go back real quick. Yep, that's right. Okay, 43.30, right? You add 5,000 shares. 43.40, that's where you added. So remember, you bought 5,000 at 43.15, and you bought 5,000 at 43.40. So far, you're with me. You bought 5,000 here, you bought 5,000 here, okay? Your new cost average is 43.27.5. How? Well, 5,000 shares times 43.15 is 215,000, blah, blah, blah. 5,000 shares times 43.40 is 217. 215 plus 217 is 432 divided by 10,000 shares. There's your cost average. There's easier ways to do this. I'm just breaking it out long form. Breaking it out long form. 43.20. Guys, what's the new stop loss? I'll give you a hint. I'm going to put my cursor right next to it. What's the new stop loss? My cursor is sitting next to it. Don't get this one wrong. What's the new stop loss? Talk to me. Come on, Goose. What's the new stop loss? That's right. It's 43.30. What's the new cost average? 43.27.4. Now, it's not much. It's not much. But if the trade stops out, assuming no slippage, if the trade stops out, you still make 2.5 cents, right? You still make $250. You still make a half of an R if the trade stops out. Think about what I just said. You make a half of an R if it stops out, if it doesn't work, okay? But what if it does, right? Is my math wrong? Ollie, I don't think my math is wrong. Ollie will help me, okay? Exactly. It's not always, well, Ollie, we know this because we, on the first example, only added what? $115 risk. Does that make sense? Now, guys, now I'm really going to throw you for a curveball. Curveball. What could we do here? Jordan, this is where you need to step up. Forget the third entry. I'm not there yet. We're not at the third entry yet. What could we do here? Talk to me, big brass balls. Talk to me. Who's got the big cojones? Come on. Somebody say it. Just say it. Jordan, thank you. Thank you for stepping up. Guys, we're $250 in the money. In the money. So not only are we not risking 500, we're gaining 250. What could we really do here? Some people are really confused. What we could do is risk it all. If we really, really wanted to, we could risk it all. And you're like, what does that mean? Well, I could take my $500 risk and add it back. In this case, $750 and add it back. Does that make sense what I'm saying? Instead of adding 5,000 shares at 43.40, you could add like 10,000 shares there. and have 15,000. Somebody do the math for me. I should have done it, but I was lazy. So what I'm saying is we added 5,000 shares at 43.40, okay? And our new cost average is 43.27.4. Great, that's awesome. But we're in the money. We're in the money. I still have the possibility or opportunity, if I still want to risk $500, I can still do that. I'm not saying you should. I'm just simply saying you could. Well, what if I added 10,000 shares there? Now what's my cost average? So now I have 15,000 shares, right? So let's do it. 43.40 times 10,000 shares should be easy math. 434,000 plus 215,740 equals, right? And we're going to divide that by 15,000. 43.31.6. Guys, I'm not even close. I'm not even close. I have a 1.6 cent risk times 15,000 shares. I'm only risking $240. I could probably add another 5,000 shares. I could probably add 15,000 shares here. Right? Think about that. Do you got, real quick. Are you following me what I'm saying? I need, just give me a yes or no. What I'm saying so far, is that making sense? Are you following me? With regard to, if I want to add more to this, I could add more than 5,000 shares. Right? I could add 10, 15. I could add a lot of shares here. Now, there's nuances here. I'm not after the nuances. Okay? Guys, there's tons of nuances. Buying power becomes a concern. Getting filled becomes a concern. Slippage becomes a concern. Yes. That's not what I'm after. I'm after the concept. I want to make sure you're understanding the concept. Okay? My point is, in this scenario, we added 5,000 shares. Great. But because of our money management, okay, you could have added way more than 5,000 shares, right? Yes, I'm not saying this is certainly not going to happen on every trade. It's the concept that I'm after. The idea here is accelerating profits without ever increasing your risk more than 1R. Accelerating profits without ever increasing risk more than 1R. Some scenarios will be like the last one, where we can only increase by 330 shares, which is $115. This is a scenario where you could increase by 15,000 shares and still be under your risk. Okay? It's the concept I want you guys to understand. It's going to vary for each trade. Some trades are going to be like this, and these are like, holy shit, this is crazy good, which is why I'm using it as an example. And other trades, you might only be able to add 50 shares, 100 shares, not much. But it's the idea of it. It's the concept of it. Okay? It does, Hunter. It does, but in some scenarios, it's not a big deal. Like, for example, in this scenario, Hunter, it's really not. Because the first trade's easy, right? The second trade gave you a very long time to do your calculations, correct? The third trade, a little tougher because you don't have much time. This is a 5-minute chart. The second ad here, shit, you had like 45 minutes to think about that one. But you're right. There will be times when this happens in like a 2 or 3 or 4 minute period. Okay? So my point, though, is how much you can accelerate profit here. So now, let's just continue with the example. So now let's just say, okay, we had 5,000 shares, and we're in the money, 2.5 cents, 2.6 cents, okay? Now, the third entry is the 3-bar play. The entry is 43.55, and the stop is 43.45. Let's say we add another 5,000 shares. But now our new cost average is 43.36.6. 10,000 times 43.27. 5,000 times 43.55, do the math, it's 15,000 shares. Cost average. The new stop loss is 43.45. 43.45. So we are 8.5 cents in the money. 8.4 cents in the money. So if you take 0.084 and you multiply it by 15,000 shares, you're already $1,260 in the money. You're already 2.5R in the money. If you stop out. If you stop out, you're already 2.5R in the money if you stop. Again, that assumes no slippage, blah, blah, blah. But for example purposes, I think it's fine. Okay? This is the power of add and reduce. But it has to be on something really good to be able to get that. You're not going to be adding and reducing on a sideways trending stock or a market that's really choppy. You're going to be adding and reducing on trades that look good, that have the possibility, the opportunity to be trending. Because that's how you make the most money on an add and reduce, is trending. Okay, now, another factor here is what? Management, right? Management. Some people will like, well, I'd be out already before this breakout even happened. Jared, that's a 25-cent move. That's 2.5 R. I'm done. That's okay. I'm okay with that. I don't have a problem with that. You get up 2 R and you walk away. But not everybody's a 2 R all or nothing trader. Some people are 4 R traders. Some people are pivot traders. Some people are bar by bar traders. So just because you're a 2 R all or nothing trader doesn't mean that everyone else has to sit on the sidelines, right? So again, it does matter. Sometimes you'll just be out, right? And then if you really like it, you'll just get back in at 43.40 because it already went 2.5 R. Like for me, I'd already be gone on this. I'd be out. I'd be gone. Of course, I'd have a wider stop loss for sure under the whole number. But the point though is this is how you can accelerate profits in a big time way. And again, to go back, not all of them will give you this opportunity to make stupid amounts of money. Now, 3R isn't bad, right? But not all of them will give you this opportunity. Sometimes it's like this. It's a kind of what I would call a rudimentary add and reduce. Yeah, it's better, right? You're making 50% more money. You're making 1R more. It's not chump change, but you are risking a little bit to get it. The second example, this is the Wilt Chamberlain of trading, right? That doesn't get any better than this. And again, like Ollie said, some of you might have the prior pivot high as your target, 43.60. Maybe you add and just walk away at 43.60. Okay, fine. Guys, that's the beauty, isn't it? There's so many different ways you can do this. You don't have to do it the way I've suggested. You don't have to add full. You could, in this case, double you're not doubling your risk, but double the shares. You could take a half lot risk, a third lot. Literally, you could take the first trade with a full lot, and then you're like a little nervous and scared, so you just add 1,000 shares instead of 5,000 shares. There's a lot of different ways you can do it, okay? What are we reducing? You're reducing your risk. Susan, after the first trade, and then at the second add, how much risk did you incur? How much risk did you incur? The answer is 0, right? 0. Now, could you have added back full? No, you're not down to $250. You're up $250, Susan. You're in the money too. It's a $750 difference. You're not down to $250. You're in the money $250. Weren't you the one who just said I'm fast at math? I know, I'm mean. I apologize. That was uncalled for. Right? You're in the money. $750 change. I'd call that a reduction in risk, wouldn't you? I'd call that a reduction in risk. Now, again, to be fair, that also depends on how much you add. You could add more than this and not reduce risk. You could add less than this and still reduce risk. It all depends on just how aggressive do you want to be? How big are your stones? How good is the stock? How good is the trade? How trendy is the day? Could you imagine the other day when NVIDIA put in like a $20 day, if you had found 1 or 2 areas to add on that and you trended like that? That's like a 20R move, right? In fact, this example, it's an $11,000 gain. Do the math. That's 22R. It's 22R. That's an entire month on one trade. And not just an average month, a good month. Now, let's pour some cold water. They don't always work. They don't always work. Okay? Let's take a look. So now, I have a stock turnaround bar, right? It's a legitimate turnaround bar, right? That's a pretty nice play, right? 11.30 by $11. Target 2 to 1 is 11.90. Kind of just misses it by like a nickel, right? Just misses your target. Okay, so 11.30 by 11, $500 risk. Shares 16.50. Target 11.90. Gain would be $1,000. Okay, that's the goal. And there's nothing wrong with this pattern. Okay, that's true too, Ollie. You can absolutely do that, but you're not going to accelerate profit. But you're correct. You would certainly reduce risk. Now, there is the same chart that you just saw. Same chart you just saw. Turn around. That was a 1 minute chart. Now we're looking at a 5 minute chart. What do you have? Lower high, lower high, lower high, lower high, little bottoming tail. Not bad. Okay. I'm going to hand this over to Ollie now, and he's going to teach the next few slides. Anyway, lower high, lower high, lower high, lower high. Bottoming tail. 11.45 is the entry. 11.25 is the stop loss. Okay? That's a standalone trade. The turnaround bar is a standalone trade, right? Go back. The turnaround bar right here. This is a standalone trade. Nice trade. Nothing wrong with it. This trade right here, buy setup. Standalone trade right there. Nothing wrong with it. Okay? Cool. Now, there they are. Right? There they are. What if you add? So, hear me out. You buy 11.30 by $11. That's the first trade. Then you add 11.45, okay, by 11.25. So what are we doing? We're buying higher up by 15 cents, but we're raising our stop by 25. So you actually lowered risk by $25, but increased the possible gain by 2x from 1,000 to almost 1,900. Okay, so average entry is 11.38. Raised stop loss is 11.25. Your risk 475. Now you're going, well, geez, Jared, where is those 3,650 shares coming from? There's your 1650. There's your 1650 from trade 1. 1650 from trade 1. There is the 2,000 from trade 2. Right? There is the 2,000 from trade 2. So there's 1,650. I know, just for whiter shades of pale, plus 2,000 equals 3,650, okay? So that's where the 3,650 comes from. Got it? That's where we got 3,650 shares. Our stop loss is 11.25. So what we're really risking is 13 cents, right? We're really risking 13 cents, 11.38 by 11.25, okay? $475, possible gain about 1,900. Now, before I continue, what's one thing you could do with your target? Notice on all three examples, we've used 3 examples. On all 3 examples, I have used the original target. What could you also do? If you were a little bit nervous or scaredy pants, you could simply just use 2R from the ad, right? Yeah, you can lower the target, exactly. Maybe you don't want 20R, maybe 10R is enough. You're like, well, I don't need to get to 44.10, 43 is fine. Maybe you don't want to wait for 11.90. Maybe you're adding just to reduce the target, right? So to get 2 to 1 out of this trade, guess what? You don't need 11.90 anymore. You only have a 13-cent stop loss. You only need 26 cents. You literally could get out of this thing at what, 11.64 instead of 11.90. You could. I'm not saying you should. I'm just simply saying you could say, oh man, things have changed a little bit. I still want 2 to 1. Still risking the same amount of money. But the goal here, the general goal, is to accelerate profits, not take the same profit. Accelerate profits. So you actually lowered your risk by $25. Okay. The possible gain is 2 to 1. Okay. Now, what about this? Shit. Right? Shit. This 5-minute triggers and actually does a pretty good job. Guys, why did I bring up that comment? Why did I bring up that comment? Jordan, talk to me. My cursor's in the right spot. Take a look. Why did I bring up that comment about you could lower your target? Because in this particular case, you would have hit target. You literally would have been out of this thing for a 2R gain. See it right here on 1164? That's 2R. And then it failed. So there are nuances to this, meaning there are times when you're going for the big win. It goes 2R and comes all the way back against you. So that's the question. Can you handle it if and when it does this? Right? It popped nicely. It's actually a really nice initial pop on the buy setup. And then it rolled over. And then it went higher for the rest of the day. If you added, you actually stopped out and lost money. If you simply took the first trade and let it go, you would have made $1,000 when it hit target. The original stop held. Okay? 100% Jordan, you're getting 2 slides ahead of me. You're getting 2 slides ahead of me. But you usually are. All right? So, nothing is perfect. Nothing works every time. And the reason I'm commenting on this is you have to be able to handle being up 1.5, 2R and giving it back if you're looking for 5 and 10 and 20R gains. So if you choose to do add and reduce, understand that often, not always, but often, you're taking away some profits for a bigger gain. Look at it like this. This is the best analogy I can think of off the top of my head. And some of you will get it and many of you won't. Add and reduce is Brewster's Millions. Add and reduce is Brewster's Millions. Do you guys remember that movie? Richard Pryor, John Candy. Great movie. Early 80s, I think it was. All right. Sorry, Jordan. I know that was like, for you, that might as well have been like 1850. Okay. The concept in the movie, you can take $3 million today, cash money. Here it is. Take it. Or you can spend $30 million in 30 days and get $300 million afterwards. Okay? That's the concept, Sophia, right? There's always a price to pay. So you could have just taken 1 or 2R on a lot of these trades. Or you can choose to reinvest some of those profits for a much larger gain. I'll repeat, you could take the small 1 or 2R, and that's okay. No one's saying it's not okay. Or you can reinvest some of those profits you made and look for a much larger gain, like the $11,000 example that would have made you an entire month's profits in one day if you were on $500 risk. Does that make sense, folks? Yes, no, not sure. Does that make sense? I just want to be clear before I move on. It's a higher level concept, tougher for new people. Okay, it's probably not something I'd recommend for new traders. But if you have, and the reason I'm commenting on this, and the reason I wouldn't recommend it for new traders is twofold. One, it's a lot going on, right? There's a lot happening. You're already a little jittery and confused. Two, okay? It's important. If you take bad trades, add and reduce isn't going to help you. And newer traders take bad trades. Okay? Good traders take good trades, and add and reduce can really accelerate profits for a good trader. Okay? Because you're in the right stuff. All right? So, the key here, like everything in trading, is consistency. making sure you do this all the time. You can't just choose when to do it and when not to do it. Not every trade will give you an opportunity. Okay? Not every trade will give you this opportunity. But when it exists, you have to take it. You can't just sometimes decide to take it and other times not, because you might have a trade like the last trade and it cost you money, right? So this is the slide I was talking about, Jordan, right here. Better ways to manage, all right? Most traders confuse high reward to risk setups with tight stops. This is not true. It's a flawed approach. It only takes one to run. And that is true. It takes one to run. But you're going to get tagged a lot more often. You know, the slippage on entry and exit is also nasty. All right? High frequency trading has made sure that it's not as scalable, right? I mean, so a new trader emailed me the other day and they were brand new, risking $5 a trade. And they're like, yeah, sometimes I use 5-cent stop losses. I'm like, what? Use a nickel stop loss. If you get a penny slippage, it's 20%. What if you get a penny in and a penny out? It's 40% of your original trade. I'm like, what are you doing? So if you need 5, 10, 20,000 shares, super tight stop losses, you're itching for slippage. I mean, you guys saw last week, there was one day, just one day, I took $700 in slippage, 2 trades. Each trade gave me $300 and some dollars in slippage. And it wasn't bad. It was only like 5% slippage. It wasn't bad. But it's still $700, right? So, flawed approach that tight stops are the best. Sometimes they're good and sometimes they're not. Support is not a penny, it's an area. Thinking that a support point will hold to the penny is super extremely naive. Why do you see when I take trades, I'm giving them 50 cents below those areas? Sometimes even more than that. I don't want to be that person that just got peekabooed, tagged by a bottoming tail by 10 cents and watch it go higher. So, tight stops, flawed approach. Support is an area, not a penny. Statistically, most losing trades stop out shortly after entry. From my experience, when I scalp, most losing trades, you're out pretty quickly. Now again, there are exceptions to this. You could be in a trade that's doing well and a news report comes out and changes everything. I'm talking about averages now, okay? So here's step 1 of take high share size to target and low share size to stops, okay? With this approach, most traders will experience far fewer stops. And you know, when I say this approach, I mean this right here. Half the shares, double the stop. Okay? How often have you been stopped by a nickel or even pennies, then watch the stock go to target? Where am I going with this? I'm giving you a broad-based approach here. I'm saying, hey, look, add and reduce is awesome, but it takes some time to perfect it. For newer traders, it's going to be a little bit more challenging. 2, support, resistance, it's not an area. Don't use the tightest stop on the chart. In fact, I'd rather see you take a wider stop loss. Half the shares, double the stop. And like Jordan was commenting, if you do get tagged like the last slide, use the 84% rule. The second trade works way more often than the first trade from my experience. At the end of the day, and I've been using this a lot recently, stop overcomplicating this business. Realize that this trading thing, career, business, is not an exact science, which means support's not a penny. The tightest stop is not always best. You have to have a little bit of gray, a little bit of flexibility. And I know that's very hard for engineers, okay? But you could still make this very detailed, right, Ollie? You could still say, for example, these are hypotheticals. If the stop loss on the chart's $1, I add 25 cents. If the stop loss on the chart's 50 cents, I add 12.5 cents. Right? You could still make it very, very regimented, right? And still very analytical, very specific. You still could do that. But when you're making your rules, just make sure you add in the fact that stocks do strange things sometimes. Meaning, give them more room. Half the shares, double the stop. Okay? Do those types of things so that there is a little bit of flexibility built into your trading plan. Not the kind of flexibility that lets you take advantage of yourself, not that kind of flexibility. the kind of flexibility that helps you stay in trades that may have shaken you. And I'm going to give you one last example, and then we're going to call it a day. Pennies matter, follow your plan. I raised my stop loss because I didn't want slippage. I got tagged at 30.01 only to watch it hit target. Don't break your plan. This is a trade that I took as a little bit of an ugly 3-bar play, but not terrible. At 30.50, my stop was 29.85, okay? And I lost $398 on it. Why? Because I didn't want slippage. So instead of keeping my stop loss at 29.85 or even 29.95, I raised it up to 30.01. And what happened? Right here, see that orange line right there? Right, I think that one of them, right there. It literally went to 30.01. Came in, took my shares, and then it went to target. It went $2 higher on a, what was that, 65-cent stop loss. That's what happens when you break your plan and do stupid shit. Okay? It was a $1,400 difference, minus 400 versus plus 1,000. I'm showing this to you because I make mistakes too. I don't like when I do. Should have taken a full lot on Apple today. Cost me some money. All right? Your plan is your plan, and it's there for a reason. It's there to help you. It's there so that you can be a profitable, productive trader. When you start fiddling with your plan in real time, you're ruining or hurting your odds, and you don't want to do that. All right? You don't want to do that. So guys, I hope today, I know that some of the slides were a little complicated, okay? Like this slide over here, for example, okay? Right there. A little complicated, I know. But when you think about the possibility to make $11,000 on a $500 risk, it's pretty impressive. Now, again, I understand there's liquidity concerns, slippage concerns, buying power concerns, all of those things. It does not take away from the power of the concept. It's still a very powerful tool in your toolbox. So I would suggest you at least take a look at it. Take a look into it, because it can certainly help accelerate your profitability in trading, because it doesn't take as many trades to get 5, 10, 15R for the month. You might add on 2 or 3 trades in the month, and they might give you an extra 2 or 3R each, and all of a sudden there's 5 or 6 more R that you wouldn't have otherwise had. Also to that point, the tightest stop is not always the best. I find giving them more room is usually better. And for the newer traders out there, half the shares, double the stop. It's going to keep you in trades longer. If they don't work, take a look into the 84% play. There's a lot to unpack in this lecture, but add and reduce was the main topic that I wanted to cover today. So I hope you guys learned a little bit about add and reduce, how to accelerate and maximize your profits to be a better trader. I'm Jared Wesley of Live Traders. We'll get back at it again next week.